Hey guys, welcome to our third seminar on oil and gas accounting. This seminar focuses on Asset Retirement Obligation, or ARO. There's a lot here, and we go through some detailed calculations and examples. On future seminars, we'll be going over revenue under an ASC 606 model and reserve report testing, so stay tuned. If you learned something new, please like, share, and subscribe.
So what we're going to be looking today is what is ARO? How should a company record ARO and then subsequently measure it? What are the disclosure requirements? How should it be treated on the cash flow? What should we do to audit the client's ARO balance? And any other common issues or pitfalls that typically arise during the process of booking or auditing ARO. So ARO is found in ASC 41020. It basically is the accounting and reporting for a company's legal obligation associated with the retirement of any long-lived asset that they acquired, constructed, developed. In oil and gas, it's referred to commonly as plugging and abandonment, or P&A. Typically, you're going to hear it referred to as P&A. It's almost always some kind of a government mandate, either a law, ordinance, statute. If you're going to operate in a given state, they have slightly varying laws that will dictate what you are required to do, what you can get away with not doing. It does apply to all entities, and it's just a normal part of business operations. So what the guidance is not applicable to is if you're going to retire an asset and prepare it for an alternative use. At that point, you're not technically retiring the asset. Therefore, 41020 is not applicable. If you intend to, incur some kind of a cost to sell or otherwise dispose of the long-lived asset, that's covered under different guidance. And obligations arising from the improper use of assets would fall under other guidance. Maintenance isn't quite relevant, and cost of replacing parts that is a component of a long-lived asset also falls under other guidance. Those are more maintenance and upkeep as opposed to some kind of a long-lived liability. So initially, whenever a company is going to incur and record an ARO liability, what they're going to do is they're going to record a liability for the asset retirement obligation. They're also going to record an equal asset for the retirement costs. So the net effect on the company's balance sheet is book an asset for $10, book a liability for $10. Subsequently, what will happen is that if no changes are made to the estimates that drive that underlying liability estimate, you're going to gradually accrete your ARO liability to the future value that you expect to incur, and you're going to amortize your asset through depletion. It essentially becomes part of your oil and gas property balance, and it's going to get depreciated the same way all of your other oil and gas assets are. So the general concept is that whenever a company drills a well, obviously they're going to install equipment, they're going to drill a hole, they'll perform fracking activities, they'll build roads, they'll have infrastructure to support the well over the life. And what ARO is that at some point, whenever the company is done with the well, they're going to be required to remove all of the equipment and restore the area in the land to what it was essentially before they got there. A good example is, for example, in the state of Louisiana, if you drill a well and it's in marshland, if you build roads to go in, one of the requirements is that oftentimes the state of Louisiana will require you to essentially get rid of the road if that's the only purpose that it served and restore the wetland to what it was like before you were there. As far as the incurring of P&A costs, retiring the asset is permanent. It is not a temporary suspension of production, which is what is referred to as a shut-in well. If for whatever reason a well has a problem and needs to be temporarily shut down, then that would be a shut-in, whereas ARO is more related to, we're going to completely stop this well, it will never produce again, and then we're going to remove it. It is a matter of operational judgment rather than just an accounting issue. Oftentimes, while the client's accounting team will be the ones recording this cost, it's going to be their operators, their engineers who are going to be determining whether it's a long-lived whether it's a long-term liability, short-term liability, and the operational metrics of what are we going to plug, when are we going to plug it. A company can plug an individual well versus plugging an entire field. I believe most commonly, at least in my experience, I've seen companies plug individual wells as needed versus plugging entire groups of wells. That kind of depends more on specific companies' operations and what they have going on. Our goal is going to be to gain an understanding of the client methodology and at least make sure that the company is consistently applying that methodology. What does P&A entail? Kind of as I had just mentioned, removing any production equipment and facilities, cementing and sealing the site, clearing up any residual items from the site, restoring the landscape, making sure that there's no future environmental damage, making sure that everything's done well enough that, for example, the well doesn't start leaking after it's been plugged and abandoned. Typically, if something like that happens, the company will have to come in and incur additional costs, but that's another topic. And as I had mentioned, most often there's government regulations that need to be complied with, and those vary from state to state, county to county. So when do you recognize the liability associated with your long-lived asset? Typically, it's going to be the period in which it's incurred. So if a company acquires a well on December 31st, then they would book the asset, the well. They would also go ahead and book the associated ARO liability, provided that the well is a producing property. If the company begins drilling a well, typically what most companies will do is that they will record ARO based on spud date or first production date, one of the two. Spud date being when did they start drilling the hole, first production date being when did they actually get product out of the ground. Typically in Texas, for example, in Southwest Texas in the Eagle Ford, the difference between spud date and first production is 2 to 3 weeks usually. So there's usually not much concern about whether they're using spud or first production date. You may have 1 or 2 wells in process at year end, depending on your client. Construction, so if they build a facility to service multiple wells, then obviously the point at which that facility is built and in place, they have incurred that liability. The caveat is that they have to be able to come up with a reasonable estimate of fair value, and they must recognize the liability even if the intention is to use the internal resource to retire the asset. When would you not recognize ARO? So there are a few things that can cause a company to not be capable of recognizing it. If the company indicates that the settlement date is indeterminate, meaning that they don't know how long the asset is going to be in use for. At that point, you would look into factors such as historical experience with similar assets, budgets or forecasts, the economic viability of the asset, the depreciable life, any anticipated changes, contractual requirements, regulatory requirements. And these are kind of the things that you'll go through and think about if a company does say that, we can't estimate when the settlement date of this liability may be. These are some of the factors that you as the auditor will eventually go through and go, okay, well, if you're not sure, then is there something reasonable that can be inferred from some of these? And if the case is yes, should they book a liability? Another example is if fair value cannot be estimated. As I mentioned before, either due to settlement date uncertainty, if they're holding the asset indefinitely, for example, certain pipelines, they might not know when they're going to remove that pipeline. Because typically once it's there for 50, 60, 100 years or more. It could be something that they put down to service a certain area, and they don't know how long the economic viability of that area may be. But as soon as the company can make a reasonable estimate of fair value, they must recognize the ARO liability. In such cases, they are required to disclose that we do have an asset retirement obligation, that we are unable to estimate fair value, and they also must disclose why that estimate cannot be made. So even if they don't actually record a liability, they still have to disclose in their financial statements, we have this liability that we don't know how much it is, and this is why. So the way that a company records and the way that ARO is booked is that the company will come up with a cost estimate. So typically, this cost estimate is gross, meaning that it will comprise 100% of the cost to plug and abandon the well. They will then determine an appropriate inflation rate, usually based on some historical factors, to come up to an inflated estimate of the future cost. They'll then bake in a market risk premium, and then they will discount that back to present value using a credit-adjusted risk-free rate. And all of these are terms that we'll cover here in just a few moments, so if this sounds confusing, don't worry, we're going to get there. Once the company has determined that present value of the future liability, that is what is recorded as your ARO liability. So in this example, if a company estimates that a well which is going to last for 9 years, 10 years, sorry, has a $100,000 cost estimate. If they're estimating a 2% inflation rate, they would come up to an inflated cost of $121,900. Assuming that there's no market risk premium, if the company's credit-adjusted risk-free rate is 4%, you would then discount that $122,000 over 10 years at 4%, and the company would record an ARO liability for about $80,000, assuming that they own 100% of the well. And then what would happen is, over the following periods, they would slowly accrete that balance such that by the time they get to the year 2030, they have the full $122,000 on their balance sheet as a liability to be paid. So the initial journal entry that the company would book, kind of as I mentioned earlier, you would debit your asset retirement cost for $80,000, and you would credit your asset retirement obligation for about $80,000. And that would be what you would record to book your initial ARO liability on day one as soon as you've drilled or constructed the asset. So, with regards to that initial entry, there are a few different factors that go into it. The first is the estimated cost to plug and abandon the property. That assumption should be reasonable and supportable. The initial estimate is going to be calculated gross, or so as I'm sure you've heard mentioned throughout the day, gross 8/8 or 100% working interest. Basically the full ownership in the well that will then be divided out amongst anyone who has a working interest in the property. When determining the gross estimate, there is no consideration of salvage value for the ARO liability. If a company is drilling multiple wells at once or developing multiple properties at once, the aggregation of assets is permitted, provided that they're the same type of asset in the same geographic location, etc. And the objective of the fair value assessment is that it would be the estimate that a third party would demand to assume the ARO under current market conditions. And the factors that you have to look in involve the assumptions such as the third party's cost to perform that plugging and abandonment activity, including any overhead, profit margin, inflation, changes in technology, extent to which cost or timing may vary, as well as any market risk premium that may be applicable. So, in determining this initial estimate, who is it that's doing the estimation? Typically, and this depends on company, management will either do the calculations, come up with an estimate themselves, or they'll engage their internal or external reserve engineers to aid them. Another thing that a company can do, and most often is probably done by, for example, PCAOB filers, is that they'll engage a third party and essentially ask for a quote and say, I have this property, here are all the specifications of it. If I were to engage you to plug and abandon this property, what would you charge me? And if management's unsure of their own internal estimate, they can definitely use something like that as supportable evidence for an estimate that they're going to use to record an ARO liability. So what data do they use? Historical P&A costs, either internal or external sources, industry average cost, or specific quotes obtained from vendors. So if management wants to derive the cost estimate themselves, then they can go out and look for other publicly available information. So if they're drilling wells in West Texas, and there are multiple public companies that are also drilling wells in West Texas, they might go out and see what are those guys using to book their ARO liability, how much is their cost estimate per well, does ours line up with what they're doing, and then how is it estimated? Typically, most companies will come up with an average cost per well, and then they will apply that across all of the wells in an area. And then if they have any frac ponds or facilities or larger projects, typically those are done specific for that individual facility or asset. It's not often that they'll come up with an estimate for frac ponds because one pond may service a few wells, another pond may service many more wells, and they could vary in size. If the company has no history of retirements, meaning that it's a brand new company, they've never actually plugged and abandoned a well, and they have no real idea what they're doing and they have no concrete evidence. At that point, we can turn to other companies we audit that have P&A activity in the same area. And as I mentioned before, publicly available P&A data can be available through PCAOB filers if you search their 10Ks. Typically, you won't see disclosed in their 10Ks exact amounts, but usually they'll say how many wells they have producing. You can see their total ARO liability, and you can infer about what their costs may be. So the next piece is the estimated settlement date. To come up with this, you'll typically use historical information. Most companies will have some kind of historical information, either from who the person that they've acquired the well from, or if it's new wells, then they may have some other relevant information that they want to use. The reserve report, whatever your reserve engineers are saying, is usually a good place to start. Initial production rates and reserve report information, again. End of lease is a possibility, but using the end of the lease isn't common, since typically what will happen is that a company may have a lease on a certain tract of land, but that lease can be extended permanently as long as there's a producing well on it. So a lease that ends in 12/31 of 22, if a company drills a well in December, they can hold on to that lease for another 40 or 50 years. Estimated economic life. This is considered the best approach. Ideally, a management case reserve report would be developed, and they would use forward-looking prices and their best estimate of how long do we actually expect this well to continue producing and be economically viable. And the other instance, and this is what it will typically be used on most often for me on my private companies, though I do have public companies who do the same thing, is that if they have a similar group of assets that they've grouped into a field, they'll come up with some reasonable estimate for how long the wells in this area typically lasted before we've had to plug them. And then they'll just apply that to any new wells in the area as well. So the inflation factor used, it's just a rate used to inflate the cost estimate to future value, or to the future value. The best source of the estimate, if you just look online, you can find publicly available historical inflation data. The Federal Reserve posts it. Inflationdata.com is another good source. And most people are going to use the average of the last several years. That way, any wild swings up or down kind of get eliminated. Typically, I think in the past several years, most companies have probably averaged 2 to 4. But given the way things are now, that may need to change if a company's drilling a well now. Inflation to fair value. So I believe these slides will be made available to you. So I will spare you going through the entire Excel formula. But this is the Excel formula that you would use to determine the future value. So equals FV, your rate, your number of periods, your payment amount, the present value, and then type. All ARO liabilities are at the end of the period, so type would almost always be 0. Your market risk premium. So it's a premium that a contractor would demand for bearing the uncertainty of settling a future obligation for today's fixed price. You would include this if it's identifiable, measurable, and significant. I believe in most cases, at least as far as I've seen, it's usually not excessively significant. But if you're working in something like offshore drilling, that may be far different than someone drilling in, say, the Eagle Ford in West Texas. You would exclude it if it cannot be evaluated by comparison to marketplace info, is completely arbitrary, or it introduces any kind of unjustified bias into the measurement. So once you've applied all those factors, you then discount to present value using a credit-adjusted risk-free rate. And ASC 410-2030 states that an entity, when using that technique, shall discount the expected cash flows using a credit-adjusted risk-free rate. Thus, the effect of an entity's credit standing is reflected in the discount rate rather than the expected cash flows. And what is a credit-adjusted risk-free rate? It's some form of a risk-free rate plus a company-specific credit adjustment. So that risk-free rate is typically, most companies will use a T-bill rate or a Treasury note rate from the Federal Reserve. The one thing to make sure that you factor in there, though, is that a company may just arbitrarily go and pull a 20-year T-bill rate. But if the company's wells aren't going to be plugged for 60 years, using a 20-year Treasury rate on a 60-year asset may not be appropriate. Likewise, if the wells are going to be plugged in 5 years, you don't want to discount to a 20-year rate for a 5-year asset. So just make sure that the rate the company's using is appropriate for the assets being recorded and the estimated useful life. Now, that company-specific credit adjustment, typically that's going to come from some kind of a credit agreement or an internal estimate. If the company has, some kind of outstanding debt or borrowings, you can look at that to get an idea. So the Excel formula for discounting back, as I said, I won't read the entire thing, but equals PV, rate, number of periods, payment amount, future value, and then type. Again, ARO is at the end of the period, so you just put 0 at the end. So here we'll look at an example. So the company drills a well, and they estimate that the cost to plug and abandon that well is going to be $80,000. They drilled it on January 1st of 21. They estimate that it's going to last for 10 years. They've estimated a 2% inflation rate, a 2.25% 10-year T-bill rate. The company's debt agreement is a 2% stated interest rate. And the company has 50% working interest in the property. Now, again, they drilled this well on January 1st. We're now looking at our measurement date of December 31st of year 1. So what would happen is that the company would book the first layer of ARO. They would input $80,000 gross costs, 50% working interest. And then once that calculation came out, the company's initial ARO estimate would have been $32,160. By 12/31, that estimate has now changed, and the present value of that future liability is now $33,500. Accordingly, the company will have booked an accretion expense during the year of the difference, about $1,400. So, some issues that can arise with initial and subsequent measurement. The inflation outlook can change depending on current economic circumstances, and so can expectations of the useful life of the well. It's very typical for companies to use a very cookie cutter approach and just book the same thing for every new well every time that they add one. But really what they should be doing is that they should be looking at each location and each well to make sure that any changes in factors or changes over time are being properly reflected in their ARO balance. So if you've got a company that's operating in multiple states, you might want to make sure and watch out that they're not using the exact same cost estimates across multiple areas. For example, the cost to plug and abandon a well in somewhere nice and flat is probably different than the cost to plug and abandon the well on the side of a mountain. So if they're operating in Texas and West Virginia, for example, they probably won't have the same ARO estimate for those two properties. If they do, we should be asking questions. The discount rate to present value is a company-specific credit adjusted risk-free rate. So the company shouldn't be using that adjustment rate just because they know someone else does. It should be tailored to their specific and current circumstances. And then that adjusted risk-free rate should take into account the maturity date. As I said before, if they're using a 20-year T-bill rate on a 5-year asset, it probably doesn't make sense. And the range of different rates will be prevalent when ARO covers different periods and will change on an annual basis. Every year they should be reevaluating what their current rate is, and any new properties should be using the most recent rate. As far as accounting entries, they are typically done on a well-by-well basis. They can be done on an aggregate basis, but I think far more often I've seen them done well-by-well. As we've already mentioned, when the debit side of ARO is recorded, it increases your asset, and then the ARO balance is a liability. And as we also mentioned, the asset side of this is going to be depleted over the life of the producing property just through units of production or whatever depreciation method they're using. So ARO in full cost versus successful effort. What are the differences? So under successful efforts, you amortize your ARO based on proved developed reserves. And once something is transferred from undeveloped to developed, it's a trigger to use proved developed reserves. Under full costs, your asset retirement cost is included in the cost pool to be amortized using proved reserves. And for undeveloped properties, the future undiscounted costs to develop those proved reserves, net of the salvage value, are included in your basis for your full cost to depletion. The asset retirement cost to be incurred in developing proved reserves should be included in the calculation as well. If the reserve report does not factor these in for whatever reason, the company should identify those costs and add them in themselves. So classification of ARO and ARC. As we've mentioned before, ARC, which is the asset retirement costs, is included in the oil and gas properties balance as a non-current asset and stays that way until settlement. ARO is recorded either as a short or long-term liability, depending on the life estimate. So if a company expects to plug and abandon a property within the next 12 months, it should be recorded as a current liability. If they intend to plug and abandon it in following the current 12 months, it should be long-term. And it is worth noting that this should be reflected in the settlement date for the ARO calculations and in the ARO layers, but it may not always be if the client has deemed the impact to be immaterial. Oftentimes what will happen is that operationally, a company may know they're going to plug a few properties, but accounting doesn't feel that it's justified in changing their ARO spreadsheet to properly reflect this. So they just say the variance is immaterial. We're not going to book anything. We're not going to adjust it. In such cases, we really should go through and ensure that if the company were to use the correct settlement dates and make a new ARO layer or modify the existing layer, that it actually does result in an immaterial variance. And in the event that it doesn't, we should then propose an adjustment. Subsequent measurement, kind of as we've been saying, is that once you've booked your liability, you will deplete your asset and you will accrete your liability to get closer to the future value. So accretion expense is based on your opening ARO balance. It uses the rate applied upon the initial recognition of that ARO. So what ends up happening whenever you book accretion is that you increase your ARO balance and then you debit accretion expense. And you calculate ARO prior to any revision of estimates. So a mnemonic is A before R, you accrete, and then you revise. You never revise and then accrete. If there's a change in the undiscounted cash flows, this should be evaluated at least annually. And ARO estimates are typically accounted for in layers. And whether you add a new layer or modify an existing layer depends on what kind of change to ARO are you making, which estimate is changing. And we'll go over that briefly in a moment. These layers typically build up over time. There's typically more than one if the well has been in existence for many years. And one well could have one layer. It may have 5 or 6 layers. It depends. So what causes us to adjust our existing layer or create a new layer? So if there is a change in the current cost estimate or inflation rate that is an upward revision, i.e., if we're increasing our inflation rate or increasing our cost estimate, then we would create a new layer. So our original line in our Excel file would stay, and we would simply create a new layer for the incremental variance. If it's a downward revision, then you're going to continue to use that historical discount inflation rate, but you're going to adjust your existing layer. And then if there's a change in the estimated settlement date, whatever layers currently exist, you're just going to change them. So another example. So cost estimate increases. So we've got a new inflation rate and a new discount rate. So we have this well that was recorded. We now estimate that it's going to cost us an additional $40,000 to plug and abandon the property. Our settlement date is still 10 years from spud. It's unchanged. Our inflation factor has now increased to 3%. Our T-bill rate is 2%. Our debt agreement rate is still 2%. So the new layer classification is going to be a revision of the estimate. And as is shown here, what would happen is that your original layer would continue to exist using that same initial $80,000 estimate, using the original T-bill and discount rates, and you would still book your original calculated accretion expense would still get recorded. And then what you would do is that in addition to that, you would add a new second layer. You would add your incremental $40,000 using your new inflation rate, using your new T-bill rate, and you would calculate your present value as of the end of the period, and there would be no accretion expense associated with this new layer, because you accrete and then you revise. So the entries that you would record in that example: step 1, you would debit accretion expense for your layer 1 accretion. You would credit your liability to increase that layer. And then subsequently, you would record your second layer. So debit oil and gas properties, credit ARO, and that represents the effect of your new increase of $40,000 that you think to the estimated cost. So example 3. So the settlement date is reduced from the original estimate, and this is just going to run through your ARO calculation. So we're now at the end of year 3. We now think that the settlement date is going to be 5 years and not 10. So we're still going to have 2 layers, and then you're going to accrete first and then revise your estimate. So for both of these layers, you would calculate accretion just like you did before. So you come up with accretion of, your 22.25. And then you would come down and revise and say that, okay, my new P&A date is going to be in 2026 and not 2030 or 2031. And as a result, we're going to come up with a new present value that is greater than our old present value. And therefore, we're going to record our accretion, and then we're going to revise our estimate and increase our ARO liability, because we're pulling that future date closer, which means that we need to now increase our current liability because we are now closer to the future plugging date. So we're now in year 4, and we're going to reduce our estimated plugging cost by $20,000. So we originally had an estimate for $80,000. We increased it by 40 to 120. We're now going to reduce that by 20 to a flat 100. So the revision date is 12/31 of 24. Our settlement date is unchanged. We still have 2 layers. And then, again, accrete and revise. So you would go through and record your accretion expense, calculate your present value at your 12/31 date, take the difference between 1/1 and 12/31, and that's going to be what you increase your asset, or that's going to be what you increase your liability and expenses by. And then subsequently, because you're doing a downward revision, you're going to take your second layer and you're going to revise that $40,000 estimate to a $20,000 estimate. And what ultimately that's going to come down to is that you're going to end up with a new fair value or present value that is less than what you had just calculated whenever you did your accretion. So then what will happen? You'll debit accretion expense, credit your liability, and then subsequently you will debit your liability and credit oil and gas properties to reduce that ARO value based on your new estimated plug-in cost. So retirements via settlements and sales of properties. If you retire via settlement under successful efforts, it goes to the P&L. Under full costs, it's capitalized and gets recorded to accumulated DD&A. If you retire via sell, it's represented as a non-cash item. Under successful efforts, it goes to gain loss. Under full cost, it goes to your full cost pool, unless it's classified as a significant sale, and then it will be part of your gain loss as well. And I believe we have another question for you. So, at minimum, a company should evaluate the underlying estimates to their ARO annually. If they're a PCAOB filer, then they may do so quarterly. More often, they'll look at things annually and decide, do we need to to make changes? If so, what changes need to be made? And that's for, if they're using common estimates like an average per well, then on an annual basis, they need to go in and reevaluate that. So, disclosure requirements. Disclosures contained in ASC 410-2050. You need to give a general description of the asset retirement obligations and the associated long-lived assets. The fair value of assets that are legally restricted for purposes of settling your ARO. A reconciliation of the beginning and ending aggregate carrying amount of your ARO. And then both the assets and liabilities for initial recognition as well as any significant changes need to be disclosed. So what your companies will have in their 10K, somewhere in the footnotes, is they'll have an ARO roll forward. So they'll show beginning balance, and then they'll have liabilities incurred, liabilities settled, accretion expense, revisions, ending balance. And then, whenever there's a significant change in one or more of those four components during the reported period, it has to be disclosed. Significance is considered by management and then assessed by the auditor. Reporting value could be either annual or on a quarterly basis, depending on the value and nature of change. As we mentioned before, if the fair value of an asset retirement obligation can't be reasonably estimated, the fact that it cannot be and the reasons why need to be disclosed. On the income statement, accretion expense is, as we've covered, an amount recognized as an expense as an operating item resulting from the increase in the carrying amount of the liability associated with ARO. Generally, it's consolidated and presented within DD&A. But if ARO is material to the company and accretion is therefore material, they may have it on its own separate line. A few of these slides, they're available. I'm not going to read the entire page for you, but here's an extract from a 10K of an accounting policy note related to ARO. It includes discussion on, disclosure related to the balance sheet as well as the income statement, basically covering, here's ARO, here's a description of our assets, a description of our liabilities, what our policy is related to when new obligations are incurred, what do we do, when do we book, how do we accrete, etc. So the ARO footnote is a discussion on the nature of the obligations. And then over the course of the next 3 slides, there are presentations that are all from the same disclosure. So here's an example of a disclosure regarding a significant event. If there are significant events, they are required to be disclosed. And in this case, the partnership obtained new quotes and conducted a new study to evaluate the cost of decommissioning its properties. It increased its ARO by $38.4 million. So in this specific example, a company had an ARO liability recorded, and then whenever they went out and got a cost estimate, they realized that they had significantly undervalued their ARO liability. Therefore, they're going to record a significant revision to their ARO. Therefore, they disclose that fact. In addition to showing it in the roll forward, they explicitly stated, here's the reason behind the substantial change that we had. So this is an example of an ARO footnote. It's an ARO roll forward footnote. So the things that are required to be shown, as we covered, ARO balance at the beginning of the period, liabilities incurred, both with properties acquired and drilled. In this case, it shows them in two separate lines. Liabilities settled. Liabilities associated with property sold as a separate reduction. Current period accretion expense, which increased our liability. And then current period revisions to previous estimates. So in this case, it looks like in the third prior year, they had that big $38 million adjustment. In the current year, they increased their adjustment by another almost $7 million due to new information that they had obtained. So a key point, the layers in your ARO calculation aren't separate liabilities. They are all just part of one same liability. And the only time that the ARO liability is measured at fair value is whenever you first book it. And then each property only has one liability, regardless of how many layers there are, and it is the obligation to retire that specific property. Remember, the layers are just a function of the calculation. They don't represent separate liabilities. Fair value disclosure presented below is from a 10K document. So, non-financial assets and liabilities measured at fair value covers, et cetera, et cetera. You can read it. Your fair value disclosure presented below. So there will be a table showing whatever the things marketed at fair value. And in the case of ARO, it's almost always going to be, typically will be a level 3 input of, unobservable inputs, because it's an estimate. There's nothing concrete that they can point to. And then they'll separate and differentiate between what's current and what's long-term. And then usually in the management discussion section on significant estimates, they will discuss, especially if ARO is material, they will discuss the nature of the ARO balance, the things that they, this kind of goes back to the earlier footnote. I believe it actually is the same earlier footnote of how do they calculate it, how do they record changes to it, etc. So on the cash flow, ARO is a non-cash supplemental disclosure. Settlements of ARO are treated as an operating activity. The liability itself is non-cash until it is settled. The journal entry at settlement would be debit ARO, credit cash. Under successful efforts, if cash is greater than ARO, then you would debit loss ARO, credit cash. And then the actual asset, as we said, is amortized over the life of the asset. No cash is involved. That will simply show up in your depreciation line. Auditing ARO, so to audit completeness. As a liability, completeness is one of your biggest concerns with ARO. What makes sure that they have all of the ARO that they need to have recorded. You can compare the current year and prior year reserve reports to determine if there are changes to PDP wells. So if a well exists now and didn't last year and it's producing, there should be an ARO liability, and then you can go and check and make sure they did book it. You can compare the listing of PDP well changes or LOS statements to ARO changes over the year. Select wells from the reserve report to make sure that they're included in the ARO detail. Now, a caveat there is that only wells with a working interest will be included in ARO. If a company has a royalty interest only, that well may not be included in ARO because the company doesn't actually have any liabilities regarding that property. They're simply getting a royalty check for the well. You can compare published press releases or knowledge gained from investor conference calls and presentations and compare that to the new wells that they've included in ARO. So if they're in a press conference or a press call, they say they drilled 4 new wells in the new area, you can go and make sure that those wells were included in your ARO detail. Another big piece is make sure that the working interest that's used in the ARO calculation agrees to the purchase agreement, the reserve report, and to the company's accounting DOI deck. If it doesn't, you should find out why, because the risk is that the company's using the incorrect working interest in their ARO calculation, and therefore are understating their ARO liability. As far as accuracy and the validity of that accuracy, as discussed before, clients typically use a cookie cutter approach. Things that we can get for support would be communication from a third-party contractor, internal engineers, obtain and understand what the company's using to determine their estimates. And estimates should be reviewed at least annually for reasonableness by the client. Failure to do so should result in a control deficiency at minimum, and depending on the nature of their ARO and the materiality, it could lead to something more. We should test wells each year to determine the reasonableness of cost estimates, inflation, credit-adjusted risk-free rate, well lives, etc., especially new properties. If any actual P&A activity has occurred, you can compare what did it actually cost you to plug and abandon a well in this area versus what did you estimate, and then compare, okay, well, if you estimated it cost you 100 and it cost you 120, if you've got 60 other wells there for 100, should they all be increased as well? And those are questions you can go ask. For well life reasonableness, the well lives used in the ARO estimate should be reasonably consistent with the estimates provided in the reserve report. As we mentioned before, ideally a management case reserve report is what management would use to determine the useful life of the well. Other issues, to the extent that estimated dismantlement and abandonment costs, net of estimated salvage values, have not been included as capitalized costs in the base for computing DD&A, because they have not yet been capitalized as asset retirement costs, an estimate of those costs should be included in the base for computing DD&A. And we kind of went over that on the successful efforts versus full cost tab. Entities should estimate the amount of those abandonment costs that will be incurred as a result of future development activities on proved reserves, and then include those amounts in the cost to be amortized. This is a significant estimate in the DD&A calculation under full cost accounting. So we need to make sure that these estimates are audited either as part of our reserve report testing, or if for whatever reason they're not included in the reserve report, separately and evaluated on their own. Because they're also, again, a significant input into the fair value of oil and gas properties to assess impairment.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Alright folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.